Hello and welcome to Portfolio Matters Weekly Update, Week 91. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what do we have this week?
Thank you, Richard. Right, first the news. Well, it already seems a long time ago, but on Monday, the UK got its third Prime Minister of the Year, Rishi Sunak, and both sterling and gilts have rallied hard. We had the ECB meeting this week, and they raised rates as expected by 0.75% to 2%. In Japan, the Bank of Japan intervened in currency markets, spending about $30 billion to try and prevent the yen from rising above 150 against the US dollar. Now, we will see whether that has any long-term effect. In the short term, it did seem to work. In China, we had the Communist Party Congress, which was uncompromising. And as a result, there's been a big sell-off in both Chinese stocks listed in Hong Kong and in the Golden Dragon Index of Chinese companies listed in the US. Essentially, Xi has consolidated power and he looks like he's going to continue with the anti-COVID lockdowns, etc., etc. Then we've had earnings season in the US, and Amazon, Google, Microsoft, and Meta have all missed forecasts. Amazon missed last night, and in after-hours trading, Amazon shares are down around 20%. And finally, Elon Musk has bought Twitter. So Liz Truss was our shortest ever serving Prime Minister. She served for a total of 44 days, and that term was rather flattered by the fact that for 2 weeks of that, the whole of the UK was locked down for the Queen's funeral. And we now have Rishi Sunak. Let's see. I thought this was great. But we've had a big rally in both sterling and gilts. Now, we will go into this in more detail. It's questionable how much of the rally in gilts was just the fact there's been a general global rally in bond prices over the past couple of weeks, in that bond prices are currently very highly correlated with equities. And so we've had a rally in both equities and bonds. And the UK rises should be seen partly in that context. We'll go through the data when we go through rates later. This is the Chinese Communist Party Congress, and these are different newspapers in China. The glories of a free press. And that the Chinese Party Congress led to a big sell-off in Chinese stocks. The sell-off in the Golden Dragon Index, I mean, that's a crash.
Well, apparently he's appointed around him in his Politburo 6 men who are basically followers. So we have the whole of China being led by one man now, and 6 yes men behind him. And I think that's a huge amount of, created a vast amount of uncertainty. And clearly one man can't be an expert in everything. So I read, actually, this is a little bit of an aside, but I think it's quite interesting. Someone was telling me the other day that if you take a more cynical view of Chinese GDP data over the last 10 years, you can determine that their GDP is actually around about 30% less than they currently claim through the issue of compounding. And if that's the case, then they really are in huge trouble economically.
Yeah.
Their debt to GDP ratios will be much higher, and they're already too high.
Yeah. Well, they have released their Q3 GDP numbers after they've, agreed on what it should be. We'll go through that in a second. This is the Golden Dragon Index, which, that has been one hell of a roller coaster ride. Now, regular viewers will know I think China is uninvestable. Ultimately, the value of any asset depends on your ability to legally enforce contract. In China, you don't have any. Therefore, I don't think these are investments. This is the yen. So as the yen slipped above 150, the Bank of Japan intervened hard, and so far it seems to have been successful. Facebook has been crushed. It missed earnings again. Amazon, this is last night. It announced its earnings after the close, and this is after hours trading. So the real price adjustment will be today. And the FANGs have now underperformed the average stock in the S&P 500 since the bottom of the pandemic. So the growth shares have really disappointed. Now, this is the ECB, which raised rates to 2% as expected, but the Taylor rule says that European rates should actually be at 8.25% to get inflation back under control. So reminder, all the central banks of the world are massively behind the curve. Okay, on to some economic data. And the big data this week was the PMIs. And the PMIs, I'm not going to go through all of these, but pause, take a look. The PMIs in the UK, Europe, and the US all missed. They were all below 50, and they all deteriorated from September. So it paints a general picture of a world economy that is now contracting, and that contraction is getting worse. Additional data was that EU consumer confidence beat expectation, but it was still terrible. And in China, frankly, we just don't know how much to believe this data. But industrial production in September beat expectations. It was 6.3% year on year in September, or so they claim, up from August. Retail sales, however, missed expectations, only up 2.5% year on year in September. Fixed asset investment, and I'll show you the graph in a second, is extraordinarily consistent over time. And that came in at 5.9% year on year. Now, there are two ways to interpret that. Either the numbers are manipulated, or they mandate that central governments and local governments hit a certain target. But the big news was really in the quarterly data. So we had Chinese GDP numbers, which had been delayed, were now published, and those beat expectations. Growth during Q3 was 3.9% year on year, whereas expectations were 3.3. In the US, we had positive GDP growth in Q3. Remember that US GDP growth was actually negative in the first two quarters. But if you dig down into the data, the reason there was positive GDP growth in Q3 in the US is almost entirely due to exports. And a lot of those exports are energy. So the US is hugely benefiting from high gas prices. It's also actually exporting a lot of oil products. Now, we also had yesterday US personal consumption expenditure inflation data. Now, I should warn you that this data is advanced data, and I believe that the final data is due to be published today. But the advanced data is very surprising. So in Q2, PCE inflation was at 7.3% annualized. According to the advanced data, it fell to 4.2% annualized, which is a massive miss. Now, I'm not sure whether to believe the forecast consensus expectations, which, according to Trading Economics, were expecting a rise to 10.5%, in which case the advanced number is a huge miss and potentially very important, because that could lead the Fed to pivot much earlier than expected. Now, the core PCE annualized inflation came in on target at 4.5%. Okay, some charts, Richard.
Thank you, Keith. So UK retail sales year on year, falling, the retail sector looking a bit poorly. UK public sector borrowing, which we've talked about quite a lot recently, looking a bit poorly.
I see that Rishi Sunak is talking about
50 billion of
yes,
tax rises and savings.
Yeah, during a recession.
Yeah. UK services PMI continuing to fall, now below 50. UK manufacturing PMI, same comment, but nearer 45 now. And the composite, obviously doing the same thing.
Reminder that 50 is neutral. Anything below 50 is contraction.
EU consumer confidence, just a pretty dreadful looking chart. EU services PMI looking like the UK one, similarly, very similar. EU manufacturing PMI, actually a little bit switched around, aren't they, from the UK, but same principle. And the composite, so contraction in Europe as well. Annualized US GDP growth. Well, that's relatively healthy.
Yes.
This quarter, the quarter just gone. And US PCE annualized quarter on quarter, as Keith said, dropping down to 4.4. And the core PCE, that one's at 4.4, I think. US global services PMI suggests the US is actually in contraction, which is not consistent with the growth of GDP. And neither is this figure consistent with the growth of GDP. So these numbers are all slightly at odds with each other.
Well, remember that the GDP growth figures are for last month, and the PMIs are, right now.
That's very true.
For October.
So the European PMIs all around are looking very poor. Germany PMI bottom left, front, and France's PMI bottom right, all falling fast. US Case-Shiller house price index is still falling rapidly.
Now, on the Case-Shiller, the way the Case-Shiller is calculated is that it only looks at houses that have been sold before and compares the latest resale price with historic resale prices. Nice. So as the housing market slows and transaction volumes fall, you would expect that A, it uses less data, but also because homeowners don't have to sell their houses unless they're in distress, you might expect it not to fall as much as the true housing than other housing indices.
Yeah. And this is a bar chart of the year-on-year movement.
Actually, sorry, Richard, that's month on month. Apologies. Month on month.
The US mortgage rate continuing to rise, 7.1%, 7.2% now. Fairly painful. There it is in a graphical form. US continuing jobless rate, as we have discussed, really sort of stabilized at this point. We'll have to see whether it starts to move up as PMIs fall. China GDP growth rate, make of it what you will. Pack of lies comes to mind, but who am I to say? Chinese industrial production growth year on year. In some senses, the China data is irrelevant because, as Keith says, you shouldn't be investing in China. It's a dangerous place to invest in. It's relevant in terms of the economic consequences for the rest of the world, but that will be what it will be.
Yes.
Chinese fixed asset investments, Keith says, remarkably consistent over the last 5 years. If you ignore the COVID period, EU, UK, US PMI has all missed expectations in October, which is, I don't know what percentage of the world economy off the top of my head, but a very sizable chunk of the world economy in aggregate. All below 50, all contracting, and this is indicating the global economy is entering a recession. US PCE inflation, those early numbers, is it peaking is the question. And if it is peaking, then the Fed may be thinking that it can start to consider not increasing interest rates and possibly to do a little bit less QT.
Okay, thank you, Richard. On to one chart. Now, we did cover this last year, but this is still an absolutely extraordinary chart. So economists have created an index of Amsterdam property prices going back to the early 17th century. And you'll see that there have been boom and bust cycles before, but the current one is absolutely extraordinary. And house prices are totally disconnected from rents. And obviously, the Dutch housing market is not unique in that around the world, Canada, Australia, all have absolutely extraordinary housing booms. And as interest rates rise, you would expect house prices to come down, back down to more reasonable levels, and that will mean big falls. So in summary, with rising interest rates, a lot of house prices are just absolutely unaffordable around the world. That means house prices will have to fall, means that construction activity will fall, and that will mean a recession, a deeper recession.
So moving on to inflation watch, we don't have a great deal in here this week. We have the data that Keith referred to in the opening section, plus effectively we have September and August inflation rates all increasing, but we're now waiting for the latest figures, and it'll be interesting to see where they come in. German producer prices have gone up by 60% in the last year or so, 2 years, and just really quite extraordinary.
Yeah, you'll notice that we had BASF and various industrial companies saying that now it was no longer economic to produce in Germany, and they were going to cut back permanently some of their production. These very high producer prices just make a lot of basic industry uneconomic in Europe.
Yeah, that's going to screw the ECB, since Germany is the only economically sound country in Euroland, and US rents looking unaffordable. Monthly hours of work to pay rent. It's almost how many hours does one work in a month? Let's say 140. So 2/5 of your work. I don't know if it's pre-tax or post-tax, based on average hourly earnings. So that's pre-tax. Not good. And the underlying inflation gauge, yeah, it's showing signs of having topped out here, and we need a couple of months more data to really understand where we are, but it's looking that way at the moment.
Yes, completely agree, Richard.
So got these very strong producer price inflationary pressures in Europe. As Keith pointed out, if industrial production moves away from Europe, then that's very bad for the European economy.
On that note, are markets and we too optimistic about inflation? Because if you look at historic forecasts of the path of inflation, they've almost always been too optimistic. So if you go back to May 2021, the expected path for inflation was it to drop rapidly back towards 2%. In fact, every month, the path is it that inflation is expected to drop rapidly back towards 2%. And so far, it has been consistently wrong. It's been consistently too optimistic.
So there's a question here as well, I think, in whether 2% is any longer a reasonable target. And that they are, it's a little bit like the economists have been programmed that inflation has to fall to 2%. And I think you can start to question that. So if the thesis being that if central banks raise interest rates, they crash the economy. If they crash the economy, the politicians won't like it for obvious reasons, as well, not a lot of people. So there's a big political imperative for the economy not to crash, which means interest rates can't rise as much, which means inflation remains higher. Now, that's the first part of it. The second then is but even with higher interest rates, how do you maintain GDP above inflation such that you are deflating away debt, which is clearly what has to happen? And the answer is, and I read an interesting article about this, one answer is that the government simply steps in and guarantees private bank credit. So rather than QE, central banks don't want to do QE anymore, rather than doing QE, the government backs bank credit as a guarantee, 100% guarantee of bank credit, which means the banks can lend without risk and continue to do so. And rather than the money going into the economy through government debt, it goes into the economy through private bank debt, which is actually quite an interesting thesis. And it can be done for a long time.
Yes, well, it's been done many times around the world, including, by Western governments during the pandemic.
Exactly. Exactly. Yeah. I think the Bundesbank, or the German government, is doing it with the 200 billion of energy guarantees that it's issuing in some way. I think they're linked to guarantees. So anyway, sorry, I interrupted you.
Well, but the thing is, the main reason you do that is that you want to ensure loan growth because you want to increase economic growth. But as you say, there is a conflict with the inflation mandate.
Yeah.
And I think central banks can only do that if economic growth and inflation is below target. Now, in the UK over the last month, what you've seen is that markets are in control. And if there's any hint that the Bank of England is being lax on its inflation mandate and the government is being profligate, then gilt yields rise. And frankly, the UK becomes insolvent. It would literally have a solvency crisis, and which would lead to a sterling crisis. So I just don't think the central banks can be lax on enforcing their mandate.
So at the moment, we have a conflict, don't we? We mustn't spend too long on this. We have a conflict between what government wants and what central banks want. And ultimately, this article was governments will win. They will roll over the central banks because they do not want recessions. They don't want economic collapse, which high interest rates induce. So there's a fight going on. And you're quite right, obviously, in what you say about UK gilts. But if all governments start behaving in this manner, then there is, and they start mandating compulsory gilt purchases or compulsory government debt purchase by pension funds and insurance companies and so forth. This process does work for a while.
Yeah, well, you would need financial repression. You would need to mandate all the banks and the pension funds to buy gilts. But going back to your point about the conflict between governments and the markets, I mean, what we have seen in the UK is exactly that over the last few weeks. And the markets won. The markets forced a change in government in the UK, as we discussed last week. So I agree there's a conflict there, but it's not at all clear to me the governments will win it.
No, but I think the point, and I agree, Keith, the point being, though, that if they win it, or if the status quo shifts, then these consensus forecasts go to 4, 5, or 6%, and that's where they flatline. And that has a huge impact on people's investment strategies.
Absolutely. Yes, absolutely. But so far, it seems that markets are winning and central banks are enforcing their mandate, raising interest rates very quickly by historic standards.
Yeah. And a final point, we're not talking quick here. We're saying if this process evolves, it will evolve over the next few years.
Yeah.
And history shows that high inflation tends to be persistent, which is very interesting.
Yeah. So the consensus is the dotted lines. Well, history tends to show that when inflation rises above 8%, it persists. And as Richard said, this debate has absolutely enormous investment implications. If interest rates stay higher for longer and we essentially have stagflation, then that's bad for bonds, is bad for essentially all asset prices. If you look at the 1970s, equities had a very poor decade and bonds were decimated.
Yeah.
But I don't think that that's true. I don't think that inflation will remain elevated this time because we have a great deal of debt in the world and the Fed is tightening rates fast, and those rates act on an enlarged debt base, and that means interest costs are rising rapidly. And we've seen from the PMIs this week that the US, Europe, and the UK are all slowing and falling into inflation. And as this table, which we showed you previously, shows, every time we go into recession, recession is very effective in getting inflation down during the period of the recession. Now, when we come out of recession, then all the dynamics Richard's been talking about could well come back into play. And we know the world is short energy. And so I'm expecting a recovery to lead rapidly to a spike in energy prices, which could well mean that inflation rises and we go through the whole cycle again quite quickly.
Yeah.
But over the next year, I'm expecting a recession to lead to a fall in inflation. So if we go back to this chart, you'll see that eventually, I think one of these is going to be right. The miss has been wrong all the time, but that does not mean that it's always going to be wrong.
You may be right, Keith. I wonder whether governments will step in sooner to control central banks.
If they do, the trouble is, Richard, if they do that, then you have an enormous sell-off in bonds, and essentially you need to put in financial repression to ensure that the fiscal deficit is funded.
Yeah, exactly.
Yeah.
It becomes it becomes a paradigm shift from what we've experienced over the last couple of decades. So
yeah. Now, it can be done. If you look at Turkey, Turkey instituted an independent central bank back in 2000, and it then had 2 decades of very low inflation. And then Erdogan comes in and decides actually he doesn't want the central bank raising rates for precisely the reasons you have articulated. He didn't want the central bank to drive the Turkish economy into recession.
Yeah.
The result has been financial chaos.
Yes. Not inconceivable outcome.
Yeah.
Well. So, appositely, moving on to recession watch. US retail inventories continue to rise. And actually, if you're a US retailer, you really don't want an inventory this big because you've got so much working capital tied up in it. which suggests there's a significant lower demand and obviously lower new orders coming through, which suggests there's going to be a slowdown in a further slowdown in manufacturing, further reduction in PMIs, and the consequently lower jobs demand and lower wage growth. This graph shows wage growth versus number of employees, and you can see that you would expect wage growth to be dropping back down quite substantially on the basis of this chart.
Yes, which would be great news for the inflation fight.
Yeah.
So Florian Kronewetter, who provided those last few charts, this is his summary. Outlook for cyclical industries, frankly, could not be worse at this point. Much weaker demand ahead, price pressures are high and growing inventories mean no end in sight. Yeah. You know, good summary.
We are moving steadily into recession.
I should warn all the viewers, actually, that this isn't going to be cheery, this week's update. So for some light relief, I put the good news towards the end.
You're supposed to do the good news first, Keith, aren't you?
Yeah, no, I've moved it. You're going to need a break after all this anyway.
Global monetary policy relentlessly tightening. Look how loose it is, though, in comparison to where it has been. How much further it has to go to come back to norm, if it ever gets back to norm. The US 20-foot container import traffic is collapsing, which is extraordinary, isn't it? Considering what happened post-COVID, we had these huge bottlenecks, and now it's just gone bang the other way.
Yeah. Okay, so what this table shows is the split between the top half of this table is leading economic data, and take a look, all of which are worsening on average. The only piece of good news is unemployment claims, which we know is a lagging indicator, remains strong. Everything else, all the leading indicators, apart from that, indicate an economy which is going to get worse. But if you look at the bottom half of the table, and those are coincident indicators, how the economy is doing now, they're holding up well. So this is a good summary of where we are now. The future looks increasingly poor, but right now the US economy is kind of resilient, but it's going to get worse.
So this chart shows the rate of fall of US house prices, and comparing them to the GFC here. And actually, you can see the rate of fall is much faster than it was in the GFC. Or rather, the change in the rate of fall is much quicker than it was in the GFC. The rate of fall it's currently at is about the same as it was at the height of the GFC. You know, we'll have to see where it goes from this point. But if interest rates are going to continue to go up, one would expect this rate of fall to, if not continue to increase, at least stabilize at a significantly negative level for some time. And the Fed has succeeded in creating a big negative wealth effect. This compares different times, different recessions with the loss of wealth as a percentage of GDP. The current period has created 54% loss of wealth as a percentage of GDP, which is quite an extraordinary. But and if you look at the sum of money that's come off the NASDAQ, it's like $2 or $3 trillion.
Yeah. Yeah, and reminder, the wealth effect is that as people's financial wealth rises, they tend to spend a small percentage of it, which adds to demand, and that works in reverse as well.
And the other thing to point out, I think, with that chart is that we're only a bit of the way through. These are all what was it at its worst. Well, we're not at its worst. We haven't got there yet.
Yes, and these are figures the end of September.
Yeah. US housing starts policy. So this is the chart of US housing starts. What happens when policy rates start to tighten, and we are actually running pretty much level with 1980 at the moment in terms of the rapidity with which the housing market, the housing starts, is falling. which,
Yes.
as Keith always says, this is a powerful leading indicator of economic activity going forwards. So current economic indicators for US economic activity contemporaneous currently are resilient. Forward-looking ones are increasingly negative, and we still believe that a recession is coming.
Thank you, Richard. Right, on to the European energy crisis. And it started well, actually. We've had very warm weather, and that means that energy demand has been lower than expected. Also, conservation measures seem to be working. People have cut their consumption, and they have turned down the dials on their thermostats, and they've delayed turning on their central heating. So what that means is that storage in Europe has continued to rise. We're very close to full storage capacity in Germany and throughout the EU. And in the short term, that's had an absolutely extraordinary effect on spot gas prices. So this is next hour Dutch TTF prices, and they went negative on Monday as EU storage was pretty near full. So this is a very story analogous to what happened to oil during the pandemic. Essentially, they're trying to find some storage for their cargoes and they can't find it. So they're paying people to take it off them. Now, these are German front month baseload power prices. And as gas prices have fallen, so those have fallen. And they are down to 152 euros per megawatt hour. But if we look at the March future, well, they haven't followed the front month down. So the market is still expecting a difficult winter. You'll notice they are more than double the front month price because gas flows remain 25% below normal. And as we've covered in previous weeks, if the gas consumption over the winter period is at normal levels, then because flows are 25% below normal, you could still run out of gas by the end of the winter. So a lot depends on how cold it's going to get. And these are the futures prices, and you'll see that the market is expecting higher prices in the coming months. Now, the white line is spot Dutch natural gas futures. The orange line is 3 years forward. So the market's expecting this to last, and you'll notice those haven't come off. High future prices compared to current prices, that's called contango, and that encourages people to store gas for future delivery. So LNG cargoes are full, and there's lots of ships coming to Europe full of LNG. Now, I thought this was a really good chart and very interesting and encouraging. The blue diamonds are gas consumption compared to normal, compared to 2021. And you'll see that in the vast majority of markets, it is well down. So that's very encouraging. It shows that consumers have been reducing their consumption, and that will help the EU get through the winter. That's also, of course, industrial companies cutting back or frankly going out of business because of the high prices. So in summary, the energy crisis has started incredibly well, thanks to mild weather and lower consumption. But harder times lie ahead as temperatures drop, and we're just going to have to wait and see. Okay, on to the UK labour market. Now, last week, we did a chart pack on the UK labour market showing that we have a problem with long-term sickness and people leaving the labour market. And frankly, it's getting worse. So this is not improving over time, unlike pretty much every other country. Now, one thing we didn't talk about was the investment implications, and the investment implications are not good. Fewer workers means lower GDP, less people working equals lower output, and that would be bad for sterling and for GDP growth. Fewer workers also mean a tighter labor market, and that means higher inflation, and interest rates need to stay higher, which is also bad for the economy. Higher inflation will be bad for sterling, bad for gilts. It's also good for wages, tighter labor market, but that's bad for corporate profits, so bad for equities. And more long-term sick means higher government welfare bill, which makes it more difficult for the UK government to restore fiscal balance, which is bad for gilts and for sterling. On to the UK mortgage market. Richard.
Thank you, Keith. So this is a chart that shows that most of the UK mortgages, as we probably all know from personal experience, are fixed for either 2 or 5 years. Unlike in the US, where they tend to be fixed for the entire term of the mortgage. And this is just the distribution of the different fixed period, rate type of fixed period. And you can see that going back to 2004, actually the majority of loans were floating. Now the majority of loans are fixed, and of those, the bulk of them are fixed for 5 years.
So actually, UK consumers have been pretty smart in that they saw these historically very low rates, and they locked them in for as long as they could, which was 5 years.
Yeah, but of course, as these fixes expire, assuming they expire at the current level of current interest rates, their new mortgage rates will be substantially higher than their old ones, and maybe by a factor of 2 or 3 or 4. Which means mortgage payments go up substantially. Cost of servicing the debt increases very substantially. And that is bad for consumer discretionary spending, because there'll be less discretionary money to spend. So 2021, the UK mortgage rates were less than 2%, and now they're above 6%. And there's an estimate by Morgan Stanley that says between 35 and 40% of UK households will see higher mortgage rates in the next 6 months as presumably as their fixed rates fall away. And obviously as new purchasers come in, new buyers come into the market for the first time, which is all going to slow the housing market. In the UK, around 350,000 households need to remortgage every quarter. And that means substantial interest rate rises for a lot of households each year coming through. And this chart just shows the distribution of the initial rates and how the timings of the remortgaging. It shows there's going to be a lot of pain coming through in the mortgage market over the next couple of years.
Yeah. So this chart is showing that actually the majority of the people needing to remortgage, their existing mortgages are under 2%, and they're going to be remortgaged at 6%.
So we have this combination of higher interest rates and higher energy costs, higher energy bills, which is going to have a devastating effect, or significant effect on UK households' disposable income. The heat map on the right-hand side shows that as utility bills rise, average utility bills rise, and mortgage rates rise, shows the proportion of households who can't pay, who will struggle to pay their mortgage. And so the combination of the two could potentially quite devastating, actually. So you could find that if interest rates go up to 7% and utility bills average at £4,000 a year, 40% of households will struggle to pay their mortgages. The mortgage book is of a higher quality than it was in the GFC, which presumably means it's got a better loan-to-value ratio. But of course, the poorest households will face this potentially historic cost of living crisis, and that is That is one of the reasons I believe that the bank, ultimately governments won't allow central banks to raise interest rates. I don't think they'll allow it. Well, they will try not to allow it, as you say, Keith. So
Yes.
monetary policy acts with a lag, and we can see why from these charts we've just had a look at. So the higher interest rates are going to feed through to higher mortgage rates over months and years to come, which means a lagging effect may be 2 or 3 years, up to 2 or 3 years, 4 or 5 if interest rates stay high. And we've got the poorest 35 to 40% of households, which is a very substantial chunk of the UK households, may end up struggling to pay their mortgages with high interest rates and high energy bill persistence. So what are the investment implications? So potentially higher rate of delinquency for banks and mortgage lenders. So higher rates of delinquency, lower profits for banks, keep clear of banks. The higher interest rates actually result in higher profits for banks as well, because they get profits from different sources. So you have to try and work out where you think the balance of risk lies on that. Bad for UK consumer businesses, much less disposable income, clearly, and potentially bad for house prices as distressed homeowners become forced sellers and move into rented accommodation. Bad for the housing sector. So we want to keep out of all those things, all of those areas.
I should also say that next week we'll be doing something on banks and precisely that question, whether they're a good investment now because their interest yields shot up, but given the delinquency outcome, is it time to dip a toe in?
And also there is talk, so the banks deposit, one of the way that the central banks control interest rates is by making banks deposit surplus cash with the central bank overnight, and they offer an interest rate for that, and that interest rate is basically the one that sets the lower bound of the interest rate. And as interest rates go up, that overnight deposit rate has to go up, which means that the excess liquidity that banks have is earning a substantial rate of interest now, which feeds through into bank profits. But the bank profits comes out of taxpayer money because taxpayers basically own central banks. So there is a problem, and governments are now starting to talk about limiting the overnight deposit rates for banks, or I presume they can't limit it because that would interfere with interest rate setting policy, but they can claw it back directly from the banks, thereby reducing bank profitability.
Yeah. Or they can put in a windfall tax, which is the other thing they're talking about.
Yeah. So my view is keep clear of banks.
Yeah.
Especially Citibank, especially Credit Suisse.
Yes.
Maybe it's a bit late for that advice now.
Okay, on to IPOs. I saw this week. 3/4 of US IPOs listed between 2019 and 2021 are trading below their listing price. And a lot of those, if you look at this bar chart on the left, are essentially well below listing price or close to zero. And in the UK this week, we had Made.com facing collapse. Its shares were issued at £2 last June. And in the listing, the founders made 90 million. Well, this is the share price performance, now at 0.5p. So basically, just don't invest in IPOs.
Yeah.
All you need to know. The seller has superior information. They sell it at the peak of its prospects to you. And then when those prospects start to fade, you're left holding the bag. Okay, and on to credit spreads. Now, corporate bond yields are rising fast from historically low levels. And that means corporate cost of capital is rising. And if you think of the valuation of a company and its cost of capital, then if you divide the earnings by its cost of capital, that should kind of give you a constant. And So higher cost of capital should mean falling valuations. And this table shows that, so based on a credit spread of 6.5% and 2023 earnings around $235 a share, you expect the S&P 500 to be trading below 3,000. Potentially, it has a lot further to fall.
Doesn't it just?
And on to retail investors, Richard.
So the performance of US equity retail investors are down on average 44% between January and October. That's gosh, that's not good, is it?
Yeah.
The average UK interactive investor client is down 12% year to date. Well, that's not so bad, I guess. Keith is up.
Yeah.
Keith is not the average UK investor client.
Oh, that's it. Well, you know, we aim to help people be better than the average, frankly.
Yeah, and equities are dangerous. They're still dangerous, and better to be sitting on cash than to lose it, I think, is the basic thing. And
yeah,
it's you have to try and determine. Of course, determining when the risk-reward ratio is in your favor is difficult, but you do need a big margin for error at the moment. And because most retail investors only pay slight attention to the stock market, they buy because it's going up, and they sell when it's going down, which is really the wrong way around. You need to be buying at the bottom or buying out near the bottom and selling near the top. So it tends to reverse. And because they come in, as we all know, you become enthusiastic when a share is going up. You think, oh, I'll have some of that.
Yeah.
Someone else is thinking, I want someone to come in and take this off my hands now. And you're the one.
So selling discipline, I think, is absolutely crucial.
Yeah.
A lot of day traders have gone back to their jobs at McDonald's. Okay, on to bear market bottoms from history. And so we're going to go through charts of 6 historic bear markets. And in each of them, the stock market bottoms long before GDP, earnings, or payroll. So this is the Eisenhower recession of 1957. So the dotted line is the S&P 500. The green line is GDP, blue line payrolls, red line is earnings. You'll see that the S&P 500 bottoms well in advance of all of them. Now, in all of these charts, you'll see the same pattern. So if you're interested, please pause and take a look. What I would add is that the live lags are likely to be longer because of that data, GDP, payrolls, and earnings. Payrolls is the only one that's going to be near contemporaneous. The others are all reported with a lag. So the real lags will all be bigger than actually shown in this chart. So this is the savings and loan crisis of the early 90s, which many of you will remember. And here we had the S&P peaking below substantially before the dip, the bottom in both earnings and payrolls. Remember, payrolls is a lagging indicator. This is the great financial crisis. And again, it's noticeable how actually in all these, the dip is less than 6 months before the bottom in GDP, although I question whether you'd know that until at least a few months later, and this is the COVID pandemic. So if we summarize all that data, and I've estimated from those charts how far in advance the bottom of the stock market is before the bottom in GDP, earnings, and payrolls, you get that we bottom around 4 months before the bottom in GDP, 10 months before the bottom in earnings, 5 months before the bottom in payrolls. So in summary, the stock market anticipates the recovery. And when attempting to time the bottom of the market, I think what you're looking at is the second derivative. So as the fall in GDP begins to slow, that is when you start thinking about buying. But we are nowhere near bottom yet. This recession is only just getting started, but this is something to think about when attempting to time the bottom in the future. And we'll obviously be talking about this live when that time comes. Okay, on to other charts, Richard.
Thank you, Keith. Car output, rolling years totals. Gosh, look how UK car production has fallen by over 50% since Brexit. Clearly, some of that is pandemic. You can see the pandemic fall there, and it bounced back up, and then it's gone back down. This is very poor for the British manufacturing, British exports.
Yeah.
The US federal budget deficit, you have the COVID low there, but the trend is inexorably downwards over the last 25 years.
I find it odd that the deficit is widening again, given how strong the US economy is. Well,
of course, it was Biden's $2 trillion inflation, whatever it was. I mean, they are doing a vast quantity of public spending.
Yeah.
I'm not quite sure how increased government debt is better. It helps sort out the problems of inflation, but.
Well, this is something to watch because higher deficits are good for the economy and good for corporate profits.
And demographic trends in many Western countries and in China will turn decisively negative over the next few decades, which makes it very difficult to achieve economic growth. Economic growth is number of people in the employment, number of people in employment times their productivity effectively. And if the number of people in employment goes down faster than the productivity increases, you get negative growth. And so if the working age employment, if the working age employable population is falling fast, it's very difficult to maintain GDP growth.
Yeah.
And as we know here, we also have this problem with large bills for entitlement spending. So these demographic changes are slow acting, but quite a big looming problem for many of the world's biggest economies.
Yes. And now, after all that misery, some good news. So thank you for Richard B, who's suggested this segment. Because actually, as I start looking for good news, there is a lot of it around. So this is the Serapeum forest in Egypt. And it's in the desert. It's entirely artificial. And so they've created this to stop desertification. And what they've done is they've taken the sewage from the nearby city of Ismailia and they process it, treat it, and then use that as fertilizer for this forest, which is of several hundred hectares.
But anyway, moving on.
You're not convinced, Richard. It's small, but it's a pilot project. I mean, presumably if you can get enough water,
Apparently it's the warmest it's ever been in the Arctic for this time of year.
Good for the polar bears, as we just covered last week.
Okay, so equity markets. A reasonable week for equity markets actually. And Hang Seng fell dramatically. That's because of worries about China and the consequences of Xi having a third term with just him in charge. Bitcoin had a good week. the pound had a good week in response to, particularly I think in response to some sense of normality and sanity in the UK government. And the US dollar basically had a bad week. About time, it's had a very strong run. And as a consequence, the euro has also risen against the US dollar. Personally, I think the euro has quite a long way further to fall, whereas I'm not sure the pound has. We shall see. So there we have the Hong Kong index, probably not finished yet, going down, I suspect. And this is a chart of the current earnings season. 71% of companies have reported they've beaten estimates by an average of 4.7%, which actually is better than we were expecting, I have to say.
Yes, no, much better than I was expecting. And I remain of the opinion that US corporate earnings are way too high compared to history.
Yeah.
And they have to come down. Now, it doesn't appear to be happening this quarter, but I still think it has to happen.
And the 60-40 portfolio, which has been lauded for many years as being the fantasticest way of investing ever, has had an appalling performance this year.
Yeah.
And the year isn't over.
Cheery thought, Richard.
US truck transport stocks have fallen much less than fundamentals would imply. There's a reasonable correlation, isn't there, between the white line of the fundamentals and the yellow line of the truck stocks, and suggests that maybe truck stocks have got 30% fall or so in front of them.
Yeah, I find it's odd that these haven't fallen further. But the, transport demand is a very good indicator of economic activity, and this is not encouraging.
No, it's not, is it? It's a good real-time indicator. Yeah, UK equities are cheap and potentially getting cheaper. So UK equities trade a 40% discount to global peers. And I think at some point it will be a good time to buy the FTSE.
Yes, you notice the break here is, mid 2016. I wonder what happened then.
There, Keith. But you would think, wouldn't you? But I think it's going to be difficult to buy it when the US market is falling, because basically the US market drives everything.
Yeah.
And only the energy sector has produced a positive return this year amongst S&P sectors, and it has produced a fairly massive positive return. And the worst for information technology, but I think that's basically because they were overvalued, and communication, consumer discretionary, and real estate. Yeah.
No surprises there.
No. Growth stocks are seeing all the downgrades. So growth is the nasty red line. And they are seeing significant downgrades in their forward earnings projections.
Okay, thank you, Richard. On to commodities and energy commodities. Okay, so oil had a good week. Brent was up 3.7%, WTI up 4%, and in the last few weeks, we've had OPEC Plus essentially saying they're going to start cutting production from November. And as you'll see in a second, inventory levels in the US are falling relentlessly. In Europe, Dutch natural gas futures fell another 13%. UK natural gas futures fell 3.6%. US natural gas futures had a bounce, up 9%, but they're incredibly volatile. Coal slipped by 1.6%, still up 127% on the year. Uranium is actually developing a bit of an upward trend, up 1.2% on the week, up 22% on the year. Some data specific to the oil market. Total US crude inventories, including the SPR, fell by a further 5 million barrels, and they're down 162 million barrels so far this year. You can't keep on drawing down from the SPR forever. And excluding the SPR, private inventories also fell by 1.6 million barrels. So releases from the SPR were not enough to fully supply private markets. US crude production was stable at 12 million barrels, and they added 2 to the rig count. So this is the crude price, had a bit of a bounce. Now, talking about Russian production, well, all the forecasts that Russian crude production would fall off a cliff with sanctions have unfortunately proven not to be the case. It's back up to its average in 2018, 2019. Now, medium term, it could well be that sanctions and the flight of all the Western service companies could lead to a decay in Russian oil production over the next few years. But right now, that's not happening. Also, in the medium term, we have a structural problem with oil supply. We're just not reinvesting. So the dark blue line here is revenues for oil companies. And you'll see historically, when revenues have gone up, so has CapEx. This time, it's not. We are just not reinvesting in future oil supply. And if you look at shale well completions, you see that publicly listed companies have only slightly increased their completed shale wells since the oil price has recovered since 2020, whereas private ones have increased their drilling rigs and their wells much faster. So all that leads to oil production growth in the US being dominated by private companies. And is this due to ESG pressures? Are US oil companies now favoring returning cash flow as dividends to investors rather than reinvesting in CapEx? And all that means that there's going to be a lack of supply coming on in future years. In other matters, so this is amusing, China is currently importing more oil from Malaysia than Malaysia actually produces. I wonder where that extra oil might be coming from.
Iran and Russia spring to mind.
Yes, exactly. It's labeled as Malaysian,
yeah.
but priced in rubles. Now, this is US inventories, and you'll see that there's a problem with gasoline and distillate. So we've talked about this previously, that the US has closed down refining capacity, and sanctions on Russia mean that the West has a structural problem with the availability of crude and of gasoline. Now, before we go on, I'd just like to talk about the oil market for a second and our view. So because week by week, we report the numbers that show inventories are continuing to fall despite releases from the SPR, which can't continue forever. And so the net effect of releases from the SPR are to suppress the market price for oil. And the SPR releases can't last forever. So a natural break might be the US midterms, which is actually end of next week. And so then you have the removal of 1 million barrels of supply, 1 million barrels a day of supply, I should say. And that may cause a spike in the oil price. And you've seen that the share prices of a lot of oil companies have recovered strongly over the last couple of months. So all that could lead to a spike in the oil price and potentially good returns for oil equities. But the reason I'm not returning to buying oil companies is that I think any spike in oil prices could be short-lived because the world economy is slowing. Slowing economy means falling demand. The oil price is very inelastic compared to demand. And so I expect any short spike in the oil price to be short-lived and it to fall again with the world economy. But as the world economy recovers in 18 months, 2 years' time, it will rapidly find that there is insufficient oil, and I expect the oil price to spike again. So these are European natural gas futures, which have fallen, as we have discussed. And actually, after those falls, Asian LNG prices are now higher than European ones. So if Europe wants to secure those LNG cargoes it needs for the winter, they're going to have to rise again. And quietly, Russia is reorientating its supply network to supply China rather than Europe. So announced this week was the gas field in Siberia, which is here.
Relatively close to the Chinese border.
Well, I think relatively, a couple of 1,000 miles. These are UK natural gas futures. US, which has had a little bounce, but at its recent lows. And the reason for that is that actually US storage has been filling up quickly over the last few weeks. This is coal, seems to have reached a permanently high plateau. I thought this was amusing. So Germany, leaders in the Green Revolution. This is a big coal mine in Germany. This is a wind farm. They're going to be demolishing the wind farm to expand the coal mine. Uranium.
What a disaster, eh?
Okay, on to industrial commodities. Richard.
Yeah, thank you, Keith. Aluminium had a good week. Cobalt didn't move. Copper has had a pretty volatile year, I think. Up for the week. I'm keeping my eye on the price of copper because I would like to reinvest in copper miners at some point, but not yet. Chromium had a reasonable week. Iron ore had an abysmal week. And lithium is on the move again in an upwards direction. It stabilized for a long time. Now it's on the move. Neodymium unchanged. Nickel a little bit changed. Tin down substantially. Ferrovanadium unmoved. And zinc very slightly down. There's aluminium.
Seems to have stabilized, found a bottom.
Yeah, doesn't it? Cobalt. Copper may also have found a bottom. And copper inventories are low and falling. We are the light blue line at the bottom of that graph. The copper market is tight. We've referred to this before, actually. Future supply looks insufficient to meet surging long-term demand in clean energy. And that is, the question is short-term demand. Chinese economy is slowing. The world economy is slowing, equals reduced copper, but green energy demands will slowly increase, which suggests that the near-term outlook for copper is poor or uncertain, and the long-term outlook is very good. So it's more a question of timing your investment than whether you should make an investment, in my view.
Yeah.
It's chromium. Iron ore looks like it's going to drop below the low of last year, and presumably because of low demand from China. There's lithium again. It's still I wonder if it's on another scream up.
Because it's almost trebled this year.
Yeah, and electric vehicles are becoming more prevalent, more production. And neodymium. So there's nickel, which has basically stabilized since about July. Tin, ferrovanadium, zinc. And the precious metals weekly checklist, better week for gold and silver, both up significantly. Good week for platinum, unchanged for rhodium, and a poor week for palladium. So then we have gold. Gold in dollars, one should point out. Silver. Platinum. Rhodium. And palladium.
I'm very struck by how lots of financial assets seem to be very positively correlated at the moment. So yeah. I don't think it's any coincidence that gold and silver have had a bounce together with the S&P 500.
Yeah.
What's also surprising, though, as we move on to rates, is that rates, so bond prices, are very correlated with the S&P. So over the last 2 weeks, we've had rising stock prices, rising bond prices, and now the S&P is rolling over. Rates seem to be rising again.
That's how the 60-40 portfolio paid off so handsomely, isn't it?
Yes.
Now we're in lockstep on the way down as well as on the way up.
Yeah, but it's surprising. You would expect bond prices to move inversely to stock prices. So it's an interesting period, but not a good one for investors where there's basically nowhere to hide.
No.
Okay, on to rates. So next week we have the FOMC meeting, and reminder, we're expecting a 75 basis point rate increase. This week we had an absolutely extraordinary rally in UK gilts, with yields at the short end falling by the best part of 50 basis points and at the far end by 40 basis points. So Rishi Sunak has succeeded in restoring market confidence for now, although he still has to find 50 billion of savings, and we await the revised budget, which has been delayed by 3 weeks. In the periphery of Europe, we also had extraordinary falls in bond yields. And so there's been this general risk-on move with investors buying both equities and bonds. And one of the reasons that bond prices have been so volatile is that liquidity has collapsed. And you can see that particularly in the case of UK gilts, which is the black line. So that's part of the reason they've been flying around so much. Now, in the US, we're going to have a lot of issuance because the deficit is still very high, but private investors have actually been net sellers of US Treasuries, and those are the yellow bars, as have foreign central banks. So who are the remaining buyers? Commercial banks and the Fed. So that would suggest poor liquidity and rising yields, although of course all this can change.
Roll on QT.
Yeah. Well, well, QE again, I think, is what we need. And we'll talk about QT. I mean, QT has barely begun. I mean, it's hardly noticeable. This is central bank holdings of government bonds. And in the case of Japan, it's high and still rising. But elsewhere in the world, we're meant to be having QT. It is barely noticeable. And so the idea that QE had no effect, if it had no effect, then QT should just be as easy as QE, but it's not.
A breeze in the park.
And long-term inflation expectations have risen very strongly in the US over the last couple of months, and that's behind the bond sell-off, or actually, frankly, a function of the bond sell-off. Now, this is the UK 10-year, and it's had an extraordinary couple of months, as has the 30 years. Some normality has returned. This is the US 10-year. Now notice that the yield on the US 10-year is now 50 basis points above the yield on the UK 10-year. And the UK economy still faces large challenges, and the UK government still has to announce its plans to balance the books. This is German 10-year, Italian, extraordinary rally in Italian and Greek 10-year bonds. We've just had a big risk on move in the last 2 weeks. So, concluding comments, both bonds and stocks have rallied hard over the past couple of weeks. And what's odd about this period is that bonds and stock prices are positively correlated. Now, historically, that has tended to happen in the build-up to recession before the Fed pivots and the Fed starts cutting rates. At that point, bonds rally, whereas equities continue to fall because earnings deteriorate. So we're really waiting for signs that the Fed is going to pivot and stop raising rates at its current speed and then start cutting them. Until then, it'd be wise to remain cautious and prudent and not take any risk in either bonds or equities. And finally, on to the seasonality chart. Now, we normally show you this chart, which shows that October is a very volatile month, but then the market recovers into November and December. Well, thank you to Wayne J for sending us this. It turns out if you split seasonality into bull markets and bear markets, you get a very different story. So the red line is seasonality in bear markets, and you don't get an end of year rally. In fact, October is quite a good month, and then you get a big sell-off in November and December. And this chart looks at bear markets through 2 different definitions. The bright red line is where the bear market is defined as the equity market being down year on year, and the dark red line is where it's defined as being below its 200-day moving average. And the seasonality pattern is quite similar between the two. In both cases, October shows a rally followed by a fade again into the end of the year. So, based on that, we should not be carried away with the recent rally in equities, which is merely following the usual pattern in a bear market. And finally, concluding comments. The markets have had a good couple of weeks, but it's not likely to last as the world economy continues to slow. Richard, what have you been up to this week?
Thank you, Keith. So I had a mildly good week last week, very mildly good. And so that puts me at the relative performance for the year against the FTSE All Share of 10%, but only 1.1% for the year today. The reason I had a mildly good week was because the price of precious metals went up. Effectively, no purchases and no sales. What am I looking at? What did I had a little glance at this week? I've actually been looking at Tesla, just out of curiosity, really, and I think that's going to go back down to like sort of somewhere around here over time. But I've also been looking at just keeping an eye on renewables. They've had a very bad time. So ferroalloy used in vanadium redox batteries, or rather vanadium, it produces vanadium redox batteries. And it's clearly had a very poor year and a half or so. Ceres Power, which is fuel cell technology, has had a very poor time from its peak in 2021.
So before you move on, Richard, ferroalloy, I am fully intending to buy back into it.
Yeah.
But it's a very small, illiquid company. Frankly, when a crash comes, the share prices of these things totally crater, and you can pick them up very cheaply. And I fully intend to do that.
Yeah, it's a question of timing, isn't it, Keith? I completely agree. So Ceres Power, which there was a lot of renewables hype, wasn't there, post-COVID, around the time of COVID and post-COVID. So ITM Power, which is energy storage and hydrogen production. None of these I've invested in, but I just think it's interesting to see what's happened to this. It's down about 85% or whatever.
Wow.
And then this is the Global Clean Energy ETF, which is actually remarkably stable in comparison to those little tiddlers.
Yeah.
So it's just something I'm keeping an eye on, really. But I have no intention of investing in them at the moment. But I just thought it's interesting to look at what's going on in that sort of area at the moment. Well,
those charts really show that in the mid caps, these technology companies, what dominates is sentiment.
Yeah.
It's optimism about the future. And when that starts to go, you need to get out and you need to be.
Yeah, exactly. You have to ride the wave, but be really, really careful, don't you?
Yeah.
Which is a very difficult thing to do. How about you, Keith? What was your week like?
Thank you, Richard. Well, my week was busy, but to no effect. So I was down by 0.1% on the week, but I'm still having a good year. Now, last week, I bought these two long-dated gilts, and the price absolutely shot up, as we've covered, to the extent that UK gilts were yielding substantially less than US Treasuries. At that point, I thought, frankly, this has gone far enough. And having made the best part of 20% in a week, I sold them, making a decent return, tax-free. Reminder, gilts are CGT exempt. And I dipped my toe back into the US long bonds. Now, I'm well aware that the recent fall in yields in the US could well be just because all risk assets have rallied. And it is too early to go back into the long bonds in any size. However, I still think that is the trade. So over the next few months, I'm looking to put that on in size. But for now, I've just put it back on. The other thing I did this week was last week we talked about how I've now got a large cash position, and I've been looking to find cash vehicles with a decent yield. Now, and I found two, both of which have their problems. So I bought the PIMCO Sterling Short Maturity UCITS ETF and the iShares Sterling Ultra Short Bond ETF. And I bought them in decent size. So you'll see that I now have 27% of my portfolio in these short-term bonds and another 25% in cash, and then 40% in US short-term bonds. So the only risk position I've got on is this 5% in US long bonds and my rump equity portfolio. Now, this is the PIMCO Sterling Short Maturity UCITS ETF, and it has a 5% yield to maturity. But you'll see, so far this year, its performance has not been good. So it's down the best part of 3%, although it does pay out monthly dividends, but those monthly dividends only give it an annual yield of 0.8%. So there's a big difference between its yield to maturity and its dividend yield. Now, I tried to call PIMCO as a private investor to discuss this, and essentially they refused to put me through. So I have filled in the contact form. It's extraordinarily difficult to get hold of these financial companies, and I've had no response. And whenever you look under the hood of the details of these ETFs, the results are not encouraging. And thank you to Wayne J of our Discord for digging through the docs, but this is, frightening. So the custodian who looks after all the paperwork for the PIMCO ETF has authority over assets worth 1.1 trillion, and it has capital of just 200,000. So if anything were to go wrong and you needed to sue these people for losing some of these assets, then you are basically, they don't have the assets to make good. However, that is an unlikely event. I think you just have to hold your nose. And this is the iShares Sterling Ultra Short Bond ETF, and that is yielding 3.5%. Unfortunately, it's also much less liquid than the PIMCO vehicle with a significant spread. So if you hold it for a short period of time, the danger is anything you make in interest will be more than offset by what you lose on the bid offer spread. So there are no perfect ways of putting your money to work and getting a decent yield on the money with your brokerage account, given rising UK rates. So this is the iShares US Treasury ETF, which regular viewers will know I bought, then sold, crystallizing a load of losses. Well, I bought back in small size. And this is the 2071 gilt, which I bought at 50 and I've sold at 62. And I've also dipped back into the 2051 US Treasury bond in small size. Okay, that's it. Thank you all for watching. Please can you press like and subscribe to the channel. And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.